Welcome everyone to the Kendall Report, where I share my 40 years of experience to help you manage your portfolios and protect your wealth. Remember to subscribe, like, and share these videos. As we look back on yesterday's action, we saw a very strong session. Markets came in stronger but started to accelerate as the machines kicked in and all the algos were pushing the markets up along the lines of all of the news coming out around the president getting released. Also, we had some strong fundamental news, which was the ISM non-manufacturing coming in at 57.6, expected around 55. This is a more material report than looking at the manufacturing, as this actually reflects a little broader sense of the economy. In spite of what most people think, the economy is coming back in line. It is also interesting, this rally happened in contrast with the governor of New York talking about shutting down certain businesses again and going through this whole lockdown situation again. It's very interesting to watch what's going on this planet right now, especially in this country, with the elections only 1 month out, all the other things that are continuing to go on with the background and expecting a second and third round of COVID. You know, this is just fear in the market. It's probably more positive than negative. The expectation of something that might happen is not as material as something that is happening. And what is happening is the economy is continuing to heal gradually, at least from what levels it can. Many years ago, I lived in the Bay Area, and I was there in the '89 earthquake, and you can't live your life based on what might happen. There might be an earthquake today, but there might not. So you can't live on what might happen. This is what a lot of analysts and folks out there are basing their investment policy on. This is not a good idea. This is an emotional, it has no basis in reality. Now, until it does happen, it's just a background fear. There's a lot of things that could happen, but once again, we pay attention to the things that are happening, and that will help guide at least from a sentiment viewpoint. But as we looked at the performance yesterday, the S&P was up 1.8%, Dow Jones up 1.7%, NASDAQ up 2.3%, and the leader was the Russell up 2.8%. This was significant as that rotation continues to happen. In tonight's technical section, we will go through the spreads and look at how that leadership it is still not material yet, but there's definitely a continuation of this setup that's going to change that leadership. The biggest thing for me that happened yesterday was the treasuries moving up above 0.77. This is also important because this is triggering the crude oil to rally, the dollar to decline, as I believe this was liquidation of treasury holdings. Also, this surge in the treasuries sets up the tone for that secondary leadership to come in with the small and mid caps, along with the financials, which is by far one of the larger sectors in the stock market. But in spite of all this, as I've talked about over the past several days, this rally that we're in, I still believe is a corrective phase. I don't think there's a lot of legs under this. So I think we will see a very quick turnaround and fall back into the trading range that we've been locked in. This week, there's no real material news coming out. So this is going to get us all focused in on that claims number and the continuing claims on Thursday. That's about all that's really coming out. The impact of that is starting to be downplayed. I will go into those details on Thursday's video. As we look forward to tomorrow, this could be a minor turning point. There's going to be some critical levels that are going to need to hold. Let's go ahead and take a look at the charts, see what they're telling us for Tuesday. As we review the WaveTech database, for the past several weeks, I've been talking to you about the 26% bullish ratio. Well, in tonight's run, we got 7,200 buy signals, only 120 sell signals, and we've now moved up to 26.22%. So this is a huge turnaround. Now there's a couple things I want to discuss about these signals. The bulk of the signals came in on daily 1.2, which is the more aggressive model. The overall optimization map leans toward 3.2, so we're going to need to see more 3.2s come in to actually make this more significant. But the fact that we've moved up to 26.22% is significant, and this is what I've been talking about for the past several weeks. So we've passed one of the hurdles. Now what this means is that we are going to continue to grind in a sideways range. And so I'm going to extrapolate out some of the meaning of the database coming at least to this level. The big key point will be moving above 42% now. This is the magic mark to show that we're going to have a short-term rally. So I don't expect that to happen, but what the 26% bullish tells me is that the probabilities of going down and making a new low are starting to fade. Now, in the technical section last night, I talked about the potential of this ABC up and then a move back down. When that move comes back down now, we're starting to build some confidence that we're not going to go through and make a new low in this pattern. So a broader trading range is starting to set up. Now, depending on what happens with the traction of the short-term models over the next 5 to 8 sessions, this is a big milestone that I've been talking about for a while. So this sets up at least that next phase of consolidation for the markets on a short-term level. As I mentioned in the opening comments, the Russell versus the NASDAQ is continuing to put this large basing pattern down, and I continue to believe this is substantial. In tonight's video, I'm going to tie this all together in how the higher interest rates and the rotation is going to play together, as this is actually showing that money is trying to find a better place to be. So they're selling the treasuries, they're starting to see some secondary flow. Now the Russell is so far behind where the NASDAQ is up roughly 25% with the Russell down 5%. So there's a lot of catch up to go here. As I've been suggesting for the last couple months, if there's going to be a giant rotation on intermediate level, that we're going to need to see these stocks kick in, also the mid cap as well. Take a look at one more of these spread charts, and the MDY, which is the mid cap versus the NASDAQ, is really starting to set that same tone, and we're seeing the indicators starting to kick in. We're starting to see some momentum in this trade. I've been talking about this trade while this basing period has been happening. We go all the way back to July. I've been talking about this trade, and this is a much longer term viewpoint. There'll be a lot of money made on this spread as we go forward. My expectation is that these spreads will continue to develop. Once we start to see some further acceleration, that will set up the tone for a further rally in the markets. We should see the S&P, the mid cap, and the small cap all outperform the NASDAQ as we go forward, as some of the leadership in these tech stocks will start to fade a little bit. That does not mean that the NASDAQ is not going to go up. As we review the S&P futures, yesterday's surge was very significant. We were able to trade above that 33.87 and close above that 50% mark, but there's still a lot of resistance here. If you look at the PPMs, they're all starting to flatten out already. My expectation is that we will not see a sharp acceleration here because this is a corrective phase. Tying together what I was just saying about the spreads, it's an ongoing process. It's going to take at least 4 to 6 weeks and maybe longer to unfold. This whole pattern may take until year end, depending on what type of elements we get. There's a lot of talk of stimulus and all that. I still don't think these guys are going to do anything prior to the election. As we review the S&P cash, there was a significant event that happened, and I have to put this out here. The projections I talked about last night was for a move toward the 0.618 level. The relationships that I discussed last night suggested that a minimum move, which would be a 0.5 relationship, would move to 34.15. We're able to print 34.09 yesterday. The futures are slightly lower from the opening. The extreme on the upside is going to be 34.38, 34.42, which is going to be that 0.618 level. And if the market should stall here, and we've already had 2 days up, this will be the third day up. I'm going to point out something that happened yesterday. The market was able to close above yesterday's RXT number, 33.9321. The high was 34.09. Right here where we closed above that. This signals 1 to 2 days of sideways to down movement. Now, with the grid upsloping, we've seen this happen before. Here's one right here. Here's another one here. We got 1 day down, then it moved up. So we could see a slight retracement and then still see, then we could see Wednesday and possibly Thursday with market moving up toward this 0.618 number. But as we look at the PPMs, you can see on a cash, they're accelerating. For PPM2 has taken out its first and second derivative. PPM3 has also broken through. The PPM 200, which tracks the 200-day moving average, is actually cut through its first and second derivative. That's the long-term trend that's underlying here, and that just tells us that this market has a huge underlying trend to the upside, and we're setting up a longer-term configuration that is likely to move much higher as we come into 21. So let's dig into this pattern a little more. As I mentioned last night, this is AB portion, and now we're working on the C wave. And as I mentioned, the relationship I'm looking for is a 0.5 or otherwise. This first leg, the A wave, was 184 handles long. This suggests that we are likely to see somewhere between a 92 and 113 point move from this low that we set here. That suggests a 34.15 to a 34.38 target. Now, if we do go sideways today because of this RXT sell signal, that still does not negate this trend. We would have to take out yesterday's low, which was 33.70, to cause an issue with this pattern. So as long as we don't take out yesterday's low, we do not have to close higher today. We could see even 2 days sideways and then a surge as we move toward this 34.15 to 34.42 level, which is that 0.618 retracement. It looks like that's where it wants to go. The weekly charts on the cash, R2 is 34.02. R3 is 34.30, so R3 would get us up to that target range that I just mentioned, 34.15 to 34.42. That would satisfy that move. I think we could see that this week. This pattern that's set up is not the configuration that we're likely just to rally off to new highs. We should continue to work within the grid, within this Fibonacci range that is plotted out. So the ranges will be back to 33.52, maybe getting back into 32.97 level, just working the grid, but likely to be next week when that happens. Just remember, because of this very contracted pattern that's unfolding, there is a reasonably high probability for the market to print up if it were to follow through early tomorrow, print up into this target range that we would see a reversal. So you could actually trade into that range and then close lower. That would actually complete the pattern, and then we'd start to see some retracement. But as it looks right now, there's enough positives going on that this pattern is likely to last for at least 2, maybe 3 more sessions. Next market we'll cover is the NASDAQ. And the NASDAQ continues to be in this very tight range. As I mentioned earlier, this pattern is a bit more contracted right now. Definitely has set up a much broader range. We're seeing some minor downside overnight. The grid suggests that we could see a move down to 11,402 be S1. R1's 11,536. We've seen a high of 11,491. So it's possible we see an R1, S1 on a daily on the NASDAQ for today. But as we go to the weekly chart, it traded up fairly close to R2 for the week, 11,537, a high 11,497. That's most likely going to be your high for the week here, is going to be the 11,537. We could spike to an R3, but I just don't see the momentum here to make that happen. Everything's faded substantially, and this pattern that I'm expecting will be within this broad range that is set up. The key number to continue to watch, as I've mentioned over the last several videos, is that 11,309, which is the 10-week moving average. That is going to be the primary demand line. Market's likely to trade a little above and below this line as we go through this week. I don't see it going much lower than 11,089, which is S1. So we'd have an S1 R2. This week could get interesting as we come into the end of the week. If we're unable to get over our R2 number, then that could suggest that we'll see some backfilling as we close out this week. Reviewing the 10-year, we are seeing the weekly chart trade above its RXT number, 7.56. If we remain above that level on Friday, that would suggest we'd see some backfilling for the next couple of weeks. But I want you to notice that the PPMs are accelerating hugely. PPM 1, a plus 3.42. This is huge. Anything over 0.25 is bullish. PPM 2 is at a plus 0.87. This is also in a trend mode. As we look at PPM 3, it's a minus 2.8. That's where the green line is. So that suggests the 860 level will be substantial resistance on the treasuries. Taking a look at the yield curve play tells you a lot about what's going on. And I told you in the opening comments I would tie this all together. But the yield's moving up. You'll see the 1030 spreads are just skyrocketing here. We're printing right at the highs that we printed back in June. But if we look at the 1030, you'll see this is where the Fed changed the entire game right here around that March 9th, 15th level. This is when they came in and intervened. They made the point, and if you could go back and watch any video that I've done in the last 6 months talking about what the Fed's doing, I said they were going to manipulate the yield curve. There will not be negative rates in this country. And this is a continuation of their manipulating and causing the yield curve to actually expand. Now, there's going to be a limitation, I think, to how high this thing will go. At some stage, they will literally start buying 30-year bonds and bringing those in to keep the prices from moving too far forward. But this is definitely what's going on here in the market, and this is something to keep an eye on as we go forward. Next market I'll cover is the U.S. dollar. As I've been discussing, that U.S. dollar is going to continue to move back toward that 10-week moving average, 93.29. The low so far has been 93.35. There's some slight pressure overnight. This is going to represent support at these levels. If you look at the market grid, you'll see that the S2 weekly is 93.17. That will be the extreme if we continue to decline, but we're just below S1 right now. So I see this thing actually starting to bottom. If these levels hold, this will suggest a slight move back toward the 21-day moving average at 93.62, currently trading 93.43. There's not a lot here, but there is quite a bit of support right down at these levels between the S2 on the daily, S3, 93.24, 93.13, last 35. So we're trading S1 right now on the daily, which is exactly 93.35. So if that level continues to hold early in the U.S. session, then we're likely to see it start to move up. The final market I'll cover is gold. Gold continues to trade within the Fibonacci ranges that are plotted from the high-low of this larger pattern that's been unfolding going back to August. And what we're seeing here is the consolidation phase, and PPMs are very flat. They're trendless. So on a short-term basis, there is no trend. We saw a little upside yesterday, primarily because of the dollar decline. And if the dollar does find support here, start to move up, we're going to move back toward probably the 10-day moving average, 1895.20. But as we look at the grid for today, 1897 to 1890 is the S3 STX number, so we could see a move back there. The other support number is that 1906 level, which is the 0.3236 retracement. So I don't see a lot of downside here. 21 and 40-day moving averages are also significant. The 21 and 40-day moving averages are also significant resistance. 1923 is the 21, the 40, 1939. As we review the weekly chart, I've been discussing this 1942 level, which is the 0.38 retracement. Also, it is the 10-week moving average, 1943. And if we look at the grid here, 1946 is R2, R1 is 1925. So we've been right exactly to an R1, 1925.70 with the high so far. This is a weekly chart at 1924.90. We've moved back to the 1915 level after printing that 25 number yesterday. This configuration will continue to unfold in the sideways range. I discussed it the other night. We should trade between the 10-week moving average at 1943 and the 21-week moving average at 1875. That's also confirmed by looking at the market grid. With the sharp deceleration that we're seeing in ppm1 of minus 0.36, that's going to be substantial resistance at that level. There's less than a 20% probability for gold to move above 1943. This will complete tonight's video. Thanks for watching. We'll see you tomorrow night.